to this week's video from the Tekwise Financial Planning Podcast. My name is Evan Frazier. Today we're going to talk about a unique investment strategy on how to beat the S&P 500 with the S&P 500. So today, what we're going to focus on is using a policy I like to call kind of a combo policy. Now, you can use this for investing in the S&P 500, but you could use this actually with really any investment strategy. You could use it with buying real estate. You could use it with buying a diversified portfolio. It doesn't have to be an index, really anything that you want. I'm just going to use the S&P 500 today just as a illustration purposes to help kind of understand how pairing a universal life policy with investments can help you actually increase return and lower risk overall. So one thing to understand today is really also first kind of the difference between a universal life policy and a whole life policy. They are similar in the sense that they are both permanent policies that, if structured correctly, will run the rest of your life. However, the whole life tends to be more conservative, and therefore their rates aren't necessarily as high of a return as a universal life. With the universal life, you have a possibility to earn a little bit higher return and have a little bit more flexibility around the death benefit. So, a couple of things that we have to just kind of start out with here for the assumptions on how this is going to work. One, we're going to take this from the perspective of a 30-year-old male who is in standard health. Okay, they have to meet and be able to get at least a standard health rating or better on an insurance policy for these numbers to work. The second thing that we're going to make some assumptions on is we're going to look at a $500 a month investment. Okay. So kind of our baseline approach is the people who dollar cost average and just buy into the S&P 500, whether it's like putting into like a 401k or an IRA, something like that, and they're just doing, $500 a month straight into something like SPY, something like that. We're going to, for purposes of this test, we're going to start in 2000. We're going to end in December of 2023. And we are going to assume that we are reinvesting all of the dividends. We are not going to be taking into consideration any tax ramifications or costs of the investment for buying and selling and things like that. And as it makes sense for all of these, we do have to disclaim this example is for educational purposes only. If you are considering doing something like this, please consult with a financial advisor. Also, if you'd like to see any of the policy illustrations or math that we use to get to this, feel free to reach out to me at evan@techwisefinancial.com, and I will send you copies of the policy examples and illustrations and stuff like that we used for running with this. So we've come for our baseline. We're saying we're going to be doing $500 a month starting in 2023. With the universal life, what we're going to do instead, we're going to put that $500 a month into the policy. Okay. Now, again, this is where it gets a little flexible. For purposes of the illustration today, what we're going to do is in years 5, 10, and 15, we're going to make a withdrawal out of the cash value of the policies at large amounts that we can have it then reinvested into the S&P 500, but without tanking the insurance policy and leaving enough in the insurance policy for it to continue being viable and working. So that means in year 5, we're going to withdraw 20,000. In year 10, we're going to be able to withdraw 34,000. Year 15, we'll have enough saved to be able to do 36,000. Now in year 20, because we had to start doing loans and there's a little bit of a drag on the loans, we would only have enough to do a $31,000 withdrawal out of the policy. in year 23, we would subtract from the investments we made to pay back the loan, so there would be no more loans issued on the policy. So here's what I find really fascinating, okay? Over that time period, starting in 2000, going to December 2023, if we just did a straight $500 a month investment in the S&P 500, we end that 23-year period at $300,442. However, taking that combo approach, we end up with $338,000 in the investments, plus we now have a funded life insurance policy with, in year 23, a death benefit of $140,000. So combining those things at the end of the year, if we take person A who just did the S&P, they've only got 300,000. Person B who did the combo approach now has two assets combined worth of 478,000. What's interesting with the policy, though, is that the death benefit on that policy will continue to grow. So it will actually provide person B with some flexibility. They want to, they could keep it as a tax-free death benefit to their heirs. They could, in retirement, start to withdraw money out of that policy tax-free. They could use it as a bridge to get, if they wanted to retire early before Social Security kicked in or before our pension kicked in or other things like that, they could use it to bridge. If there was a downturn in the market, let's say I'm turning 65 this year, we see a large crash in the market, great. Instead of pulling the investments out of the market when it's down, which is the worst time to do that, we can pull income from the policy. So not only does that combo approach get us just a higher total value of the assets, but it also buys us a lot of flexibility that a straight investment into the S&P 500 cannot do. Now, again, for today's purposes, we looked at just investments in the S&P 500, but you could do similar things into a diversified portfolio. You could do similar things into real estate. There's a lot of flexibility within that, that combining those two just makes a lot of sense. Okay. I know we also, like I said, did the periodic investments. You could set up any kind of other strategy where you could say, you know what, when the market has a 5% drawback or 10 or 15%, whatever level you want, we could then invest around those days as well, and just allow you to buy the dips while still building something in a more conservative account. Now, as we said, for this example, we're using the S&P to beat the S&P. So theoretically, the risk is the same. The underlying asset class, we're still buying the S&P 500. So our risk hasn't really changed, except we've actually lowered the risk because we've added this insurance policy that grows alongside of it that is not going to be subject to the whims of the market. All right. Thank you for joining us today. I hope you've enjoyed this video and that it's been enlightening. If you're interested in talking about this strategy or other strategies on, protecting your wealth, doing a more biblically responsible approach to your investing, feel free to reach out to me. You can call me at 719-413-5614. You can email me at evan@tekwisefinancial.com, or you can check out our website at tekwisefinancial.com. Have a blessed day.